So where are we going? That's a good question. So if you look at the uncertainty out there, there's many questions that people are asking that we don't really have an answer to at this point. And those are, when will we find a vaccine or a therapy or a cure? There's promising things coming out in the news and from the pharmaceuticals, but there's no clear answer on that. Will there be a second wave of COVID-19? I think everybody is anticipating some kind of second wave. So the real question is to what degree? Have consumers' habits changed permanently? Well, I think there's going to be some areas where there has been a permanent change. There's going to be other areas where people are going to try to get back to what they were used to, what was in their mind normal. Have industries been fundamentally altered? I think a lot of them have. If you just think about the fact that many companies are actually looking actively at having employees work from home, that is going to change the landscape out there a bit. So there will be some fundamental changes in the industries. If you look at businesses, will they recover slowly or quickly? That's all a question that's relative to how long COVID will go on. Because if we continue to open up, I think we're going to recover quickly. If we have a second wave or we start shutting things down again, I think you're going to have a rollover in businesses, and it'll slowly recover, not be quickly. What happens with the overall shape of the economy recovery? What is that going to look like? And we'll talk a little bit about what the options are out there. But let's first talk about restaurants and retail. When you're looking at the different businesses that have been closed up, this chart is kind of unsettling if you think about it. Restaurants, there was over 26,000 total closures, and it looks like there's going to be about 60% that are going to be permanent closures. That is very devastating. Shopping and retail, again, 26,000 that were closed. And they're looking towards about 48% of those being permanently closed. And you can see the same trend is with beauty and spas, bars and nightlife, fitness. They're all, getting close to that 50% mark when it comes to the potential for these companies never coming back. That is kind of a concerning when you're looking at it, because there is an employee aspect to that as well. There was a study done by MetLife and the U.S. Chamber of Commerce to try to get a feel of what's going on with these businesses out there. And they were asking in these surveys some questions, one of them being, please select the option that best fits your current situation. And it's all relative to, are you open or are you not? And how much? And in this case, there is about 79% that are open, but not fully open. 41% are fully open. The rest of that 79 are partially. And then about 20% are closed. Now, because of rounding, you'll see these numbers don't always add up to 100. But that's a big number, that 20% that potentially are closed and will be permanently. You take it a step further. The next question was, how long do you believe your business can continue to operate without shutting down permanently? And this kind of illustrates the need to get our economy back open. And I understand there's a balancing act here, but there's going to be more casualties on the business side if the longer we stay closed. And if you look at this, if 3% of the businesses out there say, if we go on a month, I'm done. 1 to 2 months, it's 12%. 3 months and under 6, it's 21% of the companies. And so we're talking about some big numbers there. Any business under 6 months, is looking at up to 36% of them not opening back up again. And then if you extrapolate that out to the number of employees that are out there working, it's not just the business owner losing everything he worked for, but it's everybody that person employed. So again, very important to get the economy rolling if we want to save those businesses. This gives you a graph that kind of shows you the relationship between temporarily closed over time and permanent closures. And again, the longer we wait, the worse this is going to look. So we got to keep moving forward. And that brings us to the possible shapes of the economic recovery here. A lot of people were talking about a V-shaped recovery. It's looking less and less likely that that's going to be the case. Why? Because if we start shutting down again, we're going to see a tipping over from an economic standpoint, to which it may look more like that W-shaped recovery, which is very frequently occurs when you're talking about recessions and the economy. So, again, how does that relate to strategies? Well, we're still looking at a pullback in the market. We are seeing that the market is weakening right now. The S&P was down yesterday. It's down again today. Same thing with the NASDAQ. So it is showing signs of weakness as this news comes out and as we start getting the information relative to earnings. Again, everybody expected it to be bad, but expectations and actually reality sometimes has a different psychological effect on investors. So initially, we were looking at a potential swoosh type recovery. But even if we do get that, the economists are looking at the recovery taking a little bit longer because of the last month rise in COVID-related cases and the shuttering in place that's going on longer than anticipated, and in some cases, the closing of different companies out there like bars. So this remains to be seen. We'll see where we're going. When you think about consumer sentiment, and this really does help drive the economy. If you look back at a year ago, the change is down about 20 points from the index of consumer sentiment. A month ago, it got more positive. Right now, it's sitting at about 78.1. You can see similar numbers with the current economic conditions and the index of consumer expectations. So as long as the numbers are going up, that's going to help drive the economy because people are going to feel more comfortable spending money. If it goes down, you're going to see more savings going on and less being pumped back in the economy. Then when you take a look at, is COVID the only thing out there? No, we've got trade issues that are still looming pretty large in the global economy. Again, it's not just the U.S. They are forefront. There's no question about that. But you can see some ramblings going over in Europe and certainly in Australia. And it's not just economic tensions that are out there. In Australia, they're really uncomfortable about how China is encroaching on their waters. So you can see some tensions rising there as well. So those are the two real big things that the economy has to overcome at this point. So let's take a look at, when we're looking forward, what are some of the things that we have to look at that are going to drive the markets? Well, the first section here, we're looking at the consumer. What kind of confidence do they have? Like I said, the higher the confidence, the more they're willing to spend money, and that helps drive the market. Are they going to spend or save? Are there going to be jobs? Are we going to increase the number of jobs, or are we going to decrease? Unfortunately, the last jobs report was worse than anticipated, and that reflected itself in the market yesterday. So there are some issues there that if the market doesn't like what it sees, if the consumer doesn't like what it sees, it's going to drive the economy a bit. Looking at it from the corporate standpoint, we're anticipating, most economists are anticipating that Q2 is going to be the trough. So we're going to hit bottom and then we're moving forward. But again, if there is another round of layoffs, that could actually kind of spread into Q3. And that's why we're a bit concerned in looking as to whether there is going to be a W recovery as opposed to that V that people were thinking it was going to happen. And then you got to look at debt and rent forgiveness. The reality is banks will not wait forever. They're being quite patient right now. Landlords are being quite patient right now, but at some point they've got to get paid too. And that's where part of this next stimulus package is coming in to help stave off the problems there. But the corporate, you look at the government and the Fed, the July fiscal package is looking to be somewhere between $1 and $2 trillion. The big hang-up between the House and the Senate really was more about how do we get people back to work and less about how much can we give them to let them shelter in place. Because, I work with a lot of business owners and I know a lot of business owners, and they are really having a hard time getting people to come back to work because they're actually making more staying home. I think it's short-sighted, but that's what's happening out there. They're making more, so they're staying home. And one of the arguments between the Senate and the House is, do we keep feeding that problem or do we start tapering off to encourage people to get back to work? And I think there'll be a good compromise that's coming out of this as we see it go forward. The election, what a wild card there, right? 9 months ago, I was talking to a tax attorney in a webinar that we had, and the tax attorney was saying that their group of tax attorneys was believing 9 months ago that Trump was a shoo-in to be reelected. And now they're saying, well, based on what we're seeing at this point, the House could stay Democrats, the Senate could go Democrat, the presidency could go Democrat, looking at the polls and the conditions out there right now. And if that happens, then there's that big question of the policies that go into play. If you see that Biden gets elected, he's clearly running on a higher tax proposal. Rolling back the tax cuts and any kind of measures that the Trump administration had put into place in order to spur the economy, they're looking at rolling that back. And that will have an effect on the economy, not only the individuals, but the businesses. So that's an issue as we move forward to see how this actually plays out. It does play into the tax strategies that we will be employing and how we would go about implementing those tax strategies, depending on whether there is a regime change in the White House and in the rest of the government. So we'll be focusing on that as we're moving forward. Also, from the Fed, you've got the yield curve. Can the Fed control that? And, I believe that the Fed has done a very good job so far. If they continue down the road they've been going, there's no reason they couldn't control that. But again, something else to watch. And lastly is the COVID disease itself. And it really affects everything else that you're looking at on this page. If there is a second wave and there's more shutdowns, it's going to affect everything else. Will there be a vaccine trial that actually has very positive results that can be moved forward? And then the Q-tip. In other words, quarantine, test, isolate, and protect. If that continues to improve the numbers, then we can continue to open up. So there's a lot out there for this next half of the year. It's going to be interesting to see the year-end report in January, February of next year when we do this again. We got some things to watch as we're moving forward. So that kind of brings us to questions and answers. So I'm going to bring Rocky back on, and we'll see if there's any kind of questions or how well we actually explain things to everybody. Rocky?
Well, it looks like we did a pretty good job here. One of the things I did note is questions we've had related to what's kind of like a realistic rate of return to expect for a growth portfolio over the next couple of years. You know, we talked about things slowing down. We talked about, you know, corporate earnings and stuff being less and taking time to grow back. So what are we thinking at Daniel Krug and Associates?
Well, you know, that's interesting. We're always trying to eke out the highest rate of return. And if you think about it from a growth standpoint, we can invest in structured type portfolios. And if you think back about that slide that Rocky showed you about how different sectors were impacted, some are, you know, flying high right now. Others may take months and months and months to recover. Well, if you're in a structured portfolio that is equally balanced between all those sectors, good and bad, you're probably not going to get the return you were accustomed to in the past. Matter of fact, they're really estimating about a 2% drop in returns. However, if you get into more of a tactical portfolio, in other words, you're going to look at those sectors that are moving forward, and you're going to kind of hold off on the sectors that you believe are not going to be moving forward for quite some time. Doesn't mean that down the road you won't get into them, but right now the tactical managers are staying away from that. So it really depends on the type portfolio. Will we be looking at the same type returns in the market? No, everybody's saying that there's going to be a little bit of muted returns. And that still plays into how the election goes too. And what do I mean by that? Well, taxes go up for business. What goes on to profits? Profits go down. Do stock pickers, do stock investors like companies where their profit is dropping? The answer is no. So they pull out and they go into other places to try to get a better rate of return. So there's a lot going on out there. We're going to watch it, and certainly we're going to be trying to eke out the best returns for our clients we can get based on the portfolio managers that we have. And we're always looking for additional investment strategies to be able to help move our clients forward, which kind of brings me to the next step. Again, getting a rate of return is extremely important. That there's no question about that. But you've heard me say this before, the advanced planning is what really allows you to keep everything or as much as you've earned. So that's where the advanced planning, a well-structured wealth management plan will give you anywhere between an additional 1 to 3% net rate of return. In other words, that which you get to keep in your pocket. So it's important to be with an active firm. It's important to be with one that really looks at the dynamics of the advanced planning, and that's where you're going to be able to keep most of your money. Rock?
Sounds good to me. That's really it for the questions. We're a little over 1 hour, so we're about where we were supposed to be at. I hope everybody enjoyed the presentation, learned something, and I think we're about done. Thank you, Dan, again for presenting. And for those out there, thank you for joining. There's no need to worry. If you take care of your family, we are ready to take care of you. So thanks again, and we will talk to you all soon. Have a good day.
Bye-bye.
Bye-bye, everybody.